Welcome, ladies and gentlemen, to Commodity TV here in Zurich for the Zurich Invest Night. And it's my honor and pleasure after a long time to talk to John McCluskey, the CEO of Alamos Gold, famous gold producer and very successful. Good morning. How are you?
I'm well. Thank you for having me.
Yeah, thanks for taking your time. It's a long time ago that we have met. And I remember like easy 10 or 11 years ago at PDAC. And Alamos was really small. Now you guys are really large producer. I think last year over 529,000 ounces. And now you have taken over Argonaut Gold in addition with the Magino mine. So let's get into that directly because it looks like you can lift a lot of synergies.
Absolutely. I think that's probably one of the best accepted deals that has happened in the gold M&A space in many years. It was, for example, it's very common in a merger like this or an acquisition like this for the target company to go up and the acquiring company to go down in price. In this case, both companies went up in price, and I think that was a great market signal that that this deal has been very well received.
How did that come? Because I think you were like neighbors, right?
Yeah, those projects have, we've been working side by side since we arrived there in late 2017. The Argonaut people had been on the ground for much longer than we had, but we took over a producing mine, whereas they were working on a development asset. So over time, we've been spending a lot of money on drilling and expansion of the Island Gold project, and by now, we have it over 6 million ounces net of over 1 million ounces of mining that we've done there. And we've also, we're undergoing a very significant expansion on the Island Gold side where we're sinking a shaft, and we would have been expanding our mill starting this year and also increasing the capacity of our tailings facility. And therein lay the opportunity because right next door, the Argonaut people had built a brand new 10,000 ton per day mill for their Magino mine. They already had a very expansive tailings facility in multiple times bigger than ours in size. And you know, the common sense of joining those two projects together, and instead of having two separate mills running all the ore from both mines through the one central mill facility, that just made nothing but good sense. Yeah.
Definitely.
Just in this year alone, because we won't start on our mill expansion, it was 55 million in savings right there. We didn't need to do a tailings lift. That's another 20 million in savings, and that was right this year alone. You know, we were going to spend roughly 135 million on the mill expansion on Island side. Well, we don't have to do that now.
That's a lot of money to save, yeah.
Yeah,
super,
absolutely.
As they are so close together, those two mines, that raises the question: what do you finally pay for Argonaut, and how many synergies you think you can realize? Because I had a bit of feeling when I went through your press release, this is almost paying by itself.
Well, in terms of the, if you look at the acquisition cost, if you look at it in terms of enterprise value, on an equity basis, it was about $330 million or so. But from an enterprise value, adding the debt to the equity side, it comes to roughly $530 million. Super. And we've realized something more than 530 million in synergies, looking at the operating cost savings and the capital savings that we don't need to incur on the Island Gold side going forward. And the optionality is another matter altogether. There are just significant opportunities in terms of future growth within the district that we can realize on the basis of this combination. There's also some significant tax synergies. There's nearly $1 billion in tax pools that we can utilize.
Okay.
And so that will push us, we would have started paying cash taxes next year in Canada. We can push that to 2028. So that's another fairly significant savings.
Okay, super. I said already in the beginning, 529,000 ounces you roughly produced last year. Where do you see 2024, 2025 then? Because I think I saw in your press release that the longer term plan is to be a 900,000 ounce producer per annum. So that's a fantastic growth story, isn't it?
It is. And, to my way of thinking, Magino just fits perfectly into what we're doing. The expansion underway at Island Gold was going to take us from, roughly 140,000 ounces a year where we are now. It would take us to close to 300,000 ounces a year. Now we add Magino, that takes it to 400,000 ounces a year before we do anything else. Before any other expansions are undertaken, we'd be at 400,000 ounces a year. And then add to that the other mining production that we have in Mexico and elsewhere in Canada. We'd be producing roughly 600,000 ounces in Canada and maybe 150,000 ounces in Mexico by 2026. And then by the time you add on our new Lynn Lake project, which will go into construction starting next year, that takes us up to 900,000 ounces a year.
Okay, super. The new project going into production, but now in construction, how do you finance that?
Everything we're doing, we're financing from our own internally generated cash flow.
Could be better.
Yeah.
Fantastic. Super. Yeah. If you look on the overall group, with Magino now in addition, I could imagine maybe the costs are not rising, maybe even going down per ounce? The reason why our costs are declining is because with the Island Gold expansion, we're essentially just building a much more efficient operation. We get the economies of scale working for us. It's the same way we brought costs down at the Young-Davidson mine. We increased in scale. We fully automated the production, and as a result, we brought costs down quite substantially at Young-Davidson. We did much the same in Mexico. We effectively have always invested in productivity, and that's produced, tremendous profits for us. But just over the last couple of years, you've seen the old ounces being produced from the main Mulatos pit. Those stopped in 2023. Now all production in Mexico is coming out of La Yaqui Grande, which is a much more profitable mine. It's we're mining near surface, we're mining higher grades, very, very high recovery oxides, so makes a lot more money. As you get into Canada and you see us benefiting from the economies of scale at Young-Davidson, you'll see us do the same thing at Island Gold. Adding Magino, it just brings down costs even further because you've got much more efficiencies by essentially combining the processing of ores coming from two mines in one mill. Fantastic. So could we say all-in sustaining costs approximately $1,300 per ounce? No, they're going to come down. We see them coming down much further. Our costs are going to be roughly $1,000 all-in sustaining costs. With that gold price? That is beautiful. Oh, yeah. Super. That leads to the question, what are you doing then with all that money? Well, as you can see, it's not like we're just expanding at Island Gold. I mean, you can almost think of adding Magino as just further expansion at Island Gold, but we're building a brand new mine in northern Manitoba, our Lynn Lake project. That's roughly a $750 million investment. And then you look at what we're doing down in Mexico. We found a brand new zone called PDA. It's over 1 million ounces already and still growing. That will be a milling operation. So it's our intention over the next couple of years to build a new mill in Mexico. So we have lots of things to invest in for the time being. We'll be investing in our growth between now and 2028 in a quite significant way. Yeah. What will you do then for the shareholders? Because you pay already a dividend, as far as I know. We've been paying a dividend since 2010, and we've paid more money back in dividends than we ever raised from the market in order to get the project started. That's how it should be. Yeah. And about share buybacks, something like that? We have done those. We tend to be more opportunistic in that regard. So when our share prices drop to a very low level, we've gone into the market and we've bought quite aggressively. So we've done well over time with share buybacks, but it's just not part of the story right now because the focus is very much on growth. We've been in a growth mode
really for the last 3 years. We've been investing very, very heavily in growth, very heavily in exploration. You know, we've added millions of ounces to our reserves over the last few years at a cost of roughly $13 per ounce. So if I can add an ounce that's worth $2,350, and if I can add that to my mineral inventory for $13, that's a far better thing to do for my shareholders than just buy back shares, right?
I would say that's a non plus ultra. Definitely. Super. Last question. How does the financial setup look with the company? Meaning, what is debt on the balance sheet? What is cash? Are you sound and safe?
Yeah,
I'm sure you are. But
we've always maintained a very conservative balance sheet. So, for example, we're completely debt-free at the moment. In fact, we have probably something north of 200 million on our balance sheet now. We also have, you know, credit facilities in place for another 600 million. So we've got really strong liquidity, and we generate a lot of cash flow. But with the post-merger, so once we take on Argonaut, we'll assume some debt from the Argonaut side, but on a debt-to-equity ratio basis, very, very small. Yeah, it's about 200, just over 200 million.
Yeah, that's almost the cash you have.
Yeah.
So that's not a problem at all. Super. Yeah. Sounds like a super story. I need to have a very, very much closer look onto your company, to be honest, because this is exactly what I like. And yeah, I wish you well. Do the growth, do all those things you just told us, and fantastic company. Really congratulations again on that.
Thank you very much.
Thank you very much, John. Ladies and gentlemen, there was John McCluskey, the CEO of Alamos Gold. You heard it. They bought just Argonaut Gold. And yeah, I must say this is an outstanding story. I'm following the story easily at 10, 12 years. And I must say what the team around John has done with the company, this is exactly how you should run mines, how you should grow your business, how you should do it in a healthy way. And don't forget, the company is paying dividends. That's the first thing. The second thing is they are by today net debt free, and they put some on, that's for sure, with Argonaut, but still over $200 million in cash, $600 million in credit facilities. And then the best thing on all is approximately $1,000, let's say $1,100 maybe, all in sustaining costs. Do your mathematics with today $2,350 gold times 600, 700,000 ounces per year. This is an outstanding pre-tax profit amount, and I think this is a super healthy company. You really should have a look onto that. Thanks for watching us. Bye-bye from Zurich.